Maya, I had this moment today right after the close where I looked at the scoreboard, saw the Dow setting another all-time intraday record and thought, what a beautiful rate relief party. Then I glanced at my other screen.
Laughs. Let me guess. The semiconductor and chip sectors getting absolutely pulverized for the second straight day?
Yes! It was like looking at two completely different worlds coexisting on the same desk. On one side, everything rate-sensitive, utilities, staples, healthcare, financials, gold, and crypto got a massive bid on a very soft jobs report. But on the other, the crowded AI hardware trade kept unwinding, and some of the biggest AI buyers reportedly moved to build their own chips.
Smiles. Bad news for jobs, good news for the Dow, and a major plot twist for NVIDIA. It was a textbook rotational day. Before we jump into the long holiday weekend, let's talk about whether this was a real shift in the cycle or just some pre-holiday leverage flushing. Disclaimer first. Quick, honest note before we dig in. This is just two curious people thinking out loud for learning and for fun. It's not investment advice and never a buy or sell call. So always do your own homework.
Welcome back to the Working Thesis. I'm Theo.
And I'm Maya. First, our necessary legal housekeeping, quick and clear. This show is for education and entertainment only, not investment advice. Everything we mentioned today, indexes, stocks, commodities, is a public example to show you how market plumbing works, never a recommendation. No buy or sell calls, no price targets. Things are swinging wild before the holiday, so verify everything live. Do your own research. Let's look at the numbers from today's close because they tell the whole story of this split-screen day. The Dow Jones Industrial Average finished up over 1%, closing around 52,900, a fresh all-time record close.
While the S&P 500 was essentially flat, technically up absolutely 0.0%, closing around 7,483.
Laughs. A 0% move on the S&P is basically the definition of a flat line. It's a rounding error of a rounding error. But the Nasdaq was where the drag showed up, falling 0.8% to finish around 25,833. And the real pain was the Philadelphia Semiconductor Index, the SOX, which fell about 5.5% today.
Yeah, a 5% drop yesterday and another 5.5% drop today is a very loud back-to-back haircut. The volatility index, the VIX, fell about 2.7% to end around 16.2, showing that while semis are deleveraging, there is absolutely no broader fear bid in the market. So, Maya, what actually lit the fuse on this rate relief party?
It was the June non-farm payrolls report, and it was an absolute miss. It showed only 57,000 jobs added, about half of the 113,000 expected.
And the revisions were even softer. May was revised down to 129,000 from 172, and across April and May, 74,000 jobs were completely erased from previous prints.
Right. The unemployment rate fell to 4.2%, but for a bad economic reason, labor force participation hit a 5-year low as discouraged workers simply stopped searching. This is a visible labor market softening. And on Wall Street, bad economic news is treated like a rate cut catalyst.
And let's sit on why that labor force participation rate is the absolute tell. When people leave the workforce, the headline unemployment rate can artificially tick down, making things look healthier than they are. But when participation hits a 5-year low, it means the labor engine is losing cylinders. It's not that people are finding jobs, it's that they are giving up. It's a classic recession scare signal wearing a rate relief coat, and why the bond market reacted so aggressively. The bond market reacted instantly. With labor slowing and disinflationary signals piling up, traders completely cut their near-term Fed hike bets.
Yes, the market now expects absolutely no hike at the late July FOMC meeting, and the probability of a September rate hike slid from over 60% down to around 53%, basically a coin flip, down from 85 just 2 days ago.
It's an incredible shift, and that is why the dollar dropped about 0.5% today. When the macro backdrop signals rate relief, it gives investors the confidence to rotate capital under the surface. They sold the tech winners and piled into defensive value.
And think about that 53% September number. Just 48 hours ago, Wall Street was practically pricing a September hike as a done deal. That kind of rapid, complete reversal in rate expectations is exactly what triggers these massive, violent sector rotations. When the rate hike fear evaporates, the defensive value names that were starved of oxygen suddenly get a massive lungful of air.
You can see that resorting clearly at the sector level. Healthcare rose over 2.5%, utilities rose over 2.2%, and consumer staples rose 2%. Classic rate relief defensives.
Meanwhile, the chip-heavy tech sector fell nearly 3%. Look at the individual losses in the semiconductor complex. SanDisk down 14%, KLA down 11.5%, Western Digital and Seagate both down 10%, and Applied Materials down 7%.
This is the deleveraging we keep talking about. When a crowded trade unwinds, the selling doesn't care about a rate-friendly day. It is a forced leverage flush, not a macro panic.
Yes, and that leverage flush is an important phrase. When an index like the SOX hits a record 19% of the S&P 500, it means almost every momentum strategy, CTA, and retail trader is packed into the same small room. When someone yells fire on a cost efficiency report like OpenAI's yesterday, they all try to squeeze through the same exit door at once. The selling becomes mechanical, driven by margin calls and programmatic stops, completely decoupled from whether the Federal Reserve cuts rates in September or not.
But today's semiconductor pain wasn't just technical. There was a major, fundamental plot twist in the news. We saw a massive wave of reports of custom silicon insourcing and supplier diversification.
First, reports that Amazon is moving its Echo, Fire TV, Alexa, and Kindle devices away from third-party chips and toward its own self-developed silicon, cutting its reliance on NVIDIA.
Second, reports that Anthropic is co-developing its own custom AI chip with Samsung. And third, reports that Google's next-generation TPU may use Intel's EMIB advanced packaging instead of TSMC's ultra-tight CoWoS.
Laughs. Intel EMIB over TSMC CoWoS? That is a massive tech reshuffle. TSMC's American shares fell over 2% today on that. What we are seeing is the giant buyers of AI chips actively diversifying away from the NVIDIA and TSMC duopoly.
And put some numbers on that Amazon and Google shift. Amazon's self-developed ASIC chips represent a massive volume play. They ship tens of millions of those smart devices every year. If they can move that massive inference workload onto their own cheap, custom silicon, their margins expand. But NVIDIA loses a giant, predictable source of demand. It proves that the token shift to the edge we covered in our Edge AI series is a real, live threat to the capacity-dependent chip giants. Now, let's keep our heads clear here. The headlines are screaming that AI chip demand is peaking, but is that the real lesson?
Not at all. This insourcing and self-developed chip boom is actually a sign of the industry maturing and diversifying, not collapsing. The build-out is so massive that it actually justifies these giants building their own custom silicon to save costs. It is demand broadening, not fading.
Exactly. It's a reweighting of the value chain. It shows us that while the capacity-elastic GPU rental pricing is fragile, the core physical inputs, the memory, the advanced foundry, and the advanced packaging remain the scarce, load-bearing walls of the entire boom, no matter whose chip is running inside the server.
Right. If Google wants to use Intel EMIB packaging, they still need advanced silicon wafers and a massive amount of high-speed memory. If Anthropic designs a chip with Samsung, they still need to manufacture it on an advanced 3-nanometer node and buy HBM. Whichever custom design wins, the physical inputs under the entire boom remain the ultimate bottlenecks. You can design your own chip, but you can't build your own TSMC or conjure up your own HBM supply. That macro shift and the weaker dollar set off some massive moves in commodities. Gold firmed up, rising over 2% to around $4,146 an ounce.
And the gold miners absolutely ripped. Companies like Yamana and IM Gold up over 5% today.
It is a beautiful validation of the real rates thesis. When the dollar firmed up last week, gold held its ground. Today, the moment the jobs print came in soft, the dollar slid, yields eased, and gold absolutely erupted. It is tracking its own distinct currency and debt leg, acting as the ultimate dollar debasement hedge, not a simple risk-off mirror.
And to put some historical perspective on this, during the great inflationary and monetary transitions of the 1970s and early 2000s, gold firmed up first while yields were still climbing, and then erupted the moment the Fed was forced to pause or cut on soft economic data. Today's price action is a textbook repeat of that exact macro rhythm. It shows that gold is behaving like a core monetary asset, responding to the structural debasement of the dollar rather than acting as a short-term volatility hedge. That same dovish, weaker dollar liquidity swept through crypto too. Bitcoin rose 2%, Ethereum gained over 5%, and Coinbase soared a massive 16%.
But the real place to watch over this long weekend is Japan. The yen slid toward 163 against the dollar, then suddenly spiked to 160 on reports of Bank of Japan rate checks with commercial banks.
Rate checks are the classic final warning before direct currency intervention. If the BOJ intervenes over a thin liquidity July 4th holiday weekend, it can send massive shockwaves through global carry trades and risk assets when markets reopen on Monday. Keep your eyes on the yen over the weekend.
And let's explain the plumbing of that carry trade for our listeners. For years, investors have borrowed cheap, low-yield yen from Japan, converted it to dollars, and used it to buy high-yielding U.S. tech stocks and treasury bills. It is a massive, leveraged money wheel. But if the yen suddenly spikes because of direct BOJ intervention, those carry trades are forced to rapidly close, which means selling the U.S. assets to buy back the yen. Over a thin holiday weekend, that mechanical unwind can get incredibly violent.
So, is this a permanent regime change where software and defensives take the lead, or just pre-holiday positioning?
The honest answer is, we don't know yet. It is genuinely ambiguous. Some analysts model hyperscaler capex growing to nearly $1 trillion by 2027, while others fear a capex slowdown as early as next year.
We don't have to guess. The ultimate test will be the coming earnings season in late July, where we'll see the actual capex guides from the tech giants. Until then, we don't chase the one-day extended defensives, and we watch if gold can hold its breakout.
Right. The late July earnings will be the absolute decoder ring. If Microsoft, Meta, and Alphabet guide their 2027 capex budgets higher once again, the AI hardware peak fears will look like a major overreaction, and the semis will likely snap back hard. But if they signal they are plateauing their spend because of efficiency, the capex discipline debate becomes the dominant narrative. Let's run tonight's net thesis read. On our first thesis, the AI value chain, we saw the token shift and custom silicon story play out. The industry is diversifying beyond NVIDIA, which re-rates software and advanced foundry, while punishing the most capacity-dependent tech.
On energy and power, our binding constraint thesis, the power names got sold off slightly with tech, but the structural grid constraint is unchanged, and gold firmed up, proving its independent debasement leg is intact. In short, the market is repricing how much hardware the AI boom needs, not whether it's happening.
We don't predict. We test the thesis as the evidence lands. We're closed tomorrow for the holiday, so enjoy the long weekend, do your own research, and we'll see you on the other side of the 4th of July.
Happy 4th of July, everyone. See you next time. And that's where we'll leave it for today. Thank you, genuinely, for spending part of your day thinking this through with us.
The whole idea of this show is pretty simple. We hold a handful of theses about the world, and we test them out loud, together, a little more each day. No crystal balls, just curiosity, and a willingness to be wrong.
So, if that's your kind of thing, stick around for the next one and tell us where we're getting it wrong. Honestly, the pushback is our favorite part.
Until next time, take care of yourself and keep asking good questions.